up move on the greenback, 96.43 on the dollar index. Now, for more on that jobs report and the view ahead for the U.S. economy, I'm joined by Kevin Cummins, U.S. Economist at UBS, who's joining us live from New York. Good morning, Kevin, and thank you so much for being with us on the show today. All-important jobs print coming in well ahead of expectations. Your first thoughts?
Hi, thanks for having me. Yeah, it was a strong report overall. We did see a really solid increase in payrolls. We also saw a tick up in wages, and that's what the Fed is generally focused on to make sure that they can begin to normalize policy.
Kevin, what's your sense? In terms of the Fed liftoff, we kept tinkering between whether it's going to be June, and then there was a view that it should be September. Then there were some who felt that we'll not see a hike at all this year. Where do you think we stand with respect to the kickoff now?
Well, I think this is the sort of job growth that the Fed is encouraged by. I don't think it's the type of number that we got this morning that's going to make the Fed any more anxious to start hiking rates in June, per se. Q1 GDP slowed down, obviously, pretty sharply. Overall activity started the year off on a soft note. But I think that this report was encouraging, and it suggests that growth is starting to rebound in Q2. And it probably likes to keep the Fed on course for a September rate hike.
So you're looking at September. What's your assessment about some of the other data points that have been coming in? So obviously the jobs market recovery seems to be pretty much on track. What about some of the slightly more mixed data points that we've got on manufacturing? The other day we had auto sales numbers. They weren't looking all that bad. What's your sense on some of the very other critical areas that the Fed will look at before it takes that final view?
Yeah, I think that's right. I mean, the light vehicle sales that we saw for the month of May was almost a 10-year high, so that was certainly encouraging. And that came on the heels of a very weak Q1 consumer spending data. Even in April, we had a weak retail sales report. So I think that May auto sales data were certainly encouraging. It's 1 month. I wouldn't over-extrapolate the strength that we saw there. But it does suggest that a lot of the weakness in Q1 was likely temporary. There was a lot of distortions related to the data. Q1 data historically have been very weak, and we typically see a rebound in Q2, similar to what we saw last year, where Q1 contracted at a 2.1% annualized rate, and in Q2 we were almost growing at 4.5%. We're not expecting that sort of growth to rebound in the second quarter. But we have 2% real GDP growth in the second quarter. UBS, we expect that sort of number. And this morning's jobs report reinforced our conviction that growth is likely reaccelerating after the contraction in Q1. Jobless claims continue to suggest further strength in the labor market in early June. And like you said, the manufacturing sector has slowed as the dollar has strengthened, and you see a slower rate of exports. But encouragingly, the manufacturing ISM survey did show a little bit of evidence that things are perking up a little bit through May.
You mentioned the dollar. I was just coming to that. So if you're talking about a rate hike in September, and I mean, if you could just quantify that, are you expecting a 25 bips to start off with? If that indeed is the case, has the dollar priced it in? Have we seen all of the dollar rally that there was to see, or is there more to go?
Yeah, well, it'll obviously depend a lot on global growth, and if anything, global growth has shifted a little lower more recently. The global economy is only growing at a moderate pace. In the second half of this year, we think the U.S. is likely to, domestic demand is still pretty strong. We expect it to pick up a bit. As far as the Fed, I think September is a reasonable expectation for when policy normalization will begin. That should be dollar positive if the U.S. economy is moving in the right direction and rates are heading higher.
All right. There are also two different schools of thought as to how we will get this rate hike cycle, and how it'll actually proceed, whether it's going to be just one hike and then a long pause, or whether the Fed will move far more frequently and more systematically. What's your sense?
Yeah, well, I think at least initially it'll be a very gradual pace. we at UBS expect the first rate hike in September, and then for the Fed to pause and then reevaluate how the rate hike is impacting things like, obviously, interest rates, but the housing sector more broadly in the U.S., because the Fed doesn't want to slow any sort of growth in the near term, but they just want to get the funds rate off the zero bound. So initially, they're going to be very slow. We expect that they'll hike again in December, and then at the end of each quarter for the first half of next year. That said, we do think inflation is going to be moving closer to the Fed's 2% target, and the unemployment rate is going to continue to fall. So I think in the back half of next year, you're likely to see a bit more aggressive Fed moving in 25 basis point movements at each of the FOMC meetings next year. But at least for the first 6 months or so, the Fed is going to be moving in a very gradual fashion. And if you were to see any sort of dislocation in the market and rates really backing up and pricing in an aggressive Fed, I think then it does raise the possibility that they'll just wait and allow the market to back up without actually following through and continuing to hike rates. So I think the pace of tightening is going to be very gradual, and it all to come down to the data. And if the data warrant further rises in rates, then the Fed will go ahead and start to move rates back to normal.
My last question for this morning, just your sense on rates, and you mentioned that we've already started seeing the volatility in the bond markets, and we've seen, the 10-year harden up. Do you think this is just a short-term period of volatility or perhaps adjustment, or do you really see rates going up? Because then that does become a bit of a problematic issue for the economy overall.
Yeah, well, you have to remember, long-term U.S. interest rates are still very low, despite the backup in the last few days here. I think what's happening in the U.S., at least prior to today's jobs data, a lot was dependent upon global interest rates and what's going on with the Bund over in Germany. The economic data in the euro area have improved a bit. Inflation is starting to move back in a better direction. For the ECB. The ECB is going to continue to buy in the midst of security purchases and continue with their QE program. So I don't expect any sort of significant continuation of the sort of movements that we saw in the last few days. But as far as the fundamentals here in the U.S., they are poised to get better. So you would expect to see interest rates begin to gradually increase here in the U.S. We have the 10-year Treasury note. We expect that to end around 2.50 by the end of this year and closer to 3% by the end of next year as the Fed continues to move rates higher.
Okay, it's time to get ready for 2.50 and at least one rate hike in September. Kevin, great talking to you. Thank you so much for joining us on the show today.